Okay, so we have tax consequences on capital gains or dividends. So what can we do about it? What are some things we can do? One thing you can do is to buy tax efficient funds or vehicles. Mentioned earlier, like mutual funds, for example, that have a high turnover rate, they're constantly buying and selling, is going to incur more taxes than a fund that might be selling less or buying and selling less. They're just trying to match an index, for example. That's one way they can be more tax efficient. There's also funds like mutual funds that advertise and promote that they're tax efficient mutual funds. Their whole thing is they're trying not to incur taxes or incur tax type things to try to get you your end overall gain to be a little bit better too. So if you're in a high tax bracket especially, and you're incurring lots of taxes, for example, from your investments, you might want to look at a tax efficient fund. Another consideration or way you can avoid taxes is to buy and hold, because taxes don't occur until you sell that item. Now, a mutual fund is different because that's where they're constantly buying and selling inside the mutual fund. You don't have much control over that. A tax advantaged mutual fund might try to limit it, but once again, you don't have control on that. You're at the mercy of the person managing that fund. Where if you buy your own individual stocks, once you buy that stock, that's your cash basis, you don't incur a tax on that individual stock until you sell. You might not sell that stock for 20, 30, 40 years. You might not ever sell that stock and pass that on to your heirs. And maybe there's some tax advantages in terms of estate planning or what happens when you die, as far as is there a tax advantage to your heir, maybe to avoid taxes depending on where in the world you live. So look at that as far as anybody who's involved with estate planning or your attorney with that. But the idea is I might buy and then I might not sell till many, many years. Until I sell, I'm not incurring a tax on a capital gain when I buy and hold. I'm not incurring that tax on the capital gain. Now, if I'm buying and holding a stock for 20, 30 years and it pays a dividend every quarter or pays a dividend every year, well, every year I'm going to pay taxes on that dividend that comes out every year. But I won't pay taxes on the overall gain until I sell the stock. If you have questions around that, just throw that in the question and answer area too, by the way. It can get a little confusing on that. But, once again, when I sell, that's when I have my capital gain tax. And then when I have dividends paying out, I pay tax on dividends, every year. Another thing you can look at is tax advantaged accounts. And all over the world, they might have different tax advantage accounts. You might not have a tax advantage account where you live. I'm not sure. I've got 141 countries with great students from all those countries. I'll give you an example, though. I happen to be from the United States, so I can talk to that a little bit more specifically as an example. So in the United States, we have plans that are called like a 401k plan or a Roth IRA or IRAs. There's different things out there. Most are 401k and Roth IRAs. And the whole idea of that is you're taking income and you're putting a certain percentage of that into these tax advantage vehicles, so your gains grow without being taxed until later. Even you're not even incurring capital gains tax, you're not incurring even dividend tax while that's growing. It's in a tax advantage account. So that's a good place to put especially income generating investments such as high dividend paying stocks, for example, because then you're not paying right away on that dividend, or bonds and things too, things that are paying out regular income type things. Put them in a 401k or a Roth IRA. You can have them outside too, but if they're outside a tax advantaged account, well, then you'll pay tax on it right away, and that's okay. Just be aware that's what's happening. But if you have something you want to defer the taxes on, you can use that with a 401k or Roth IRA. And these plans are a little bit different too, like a Roth. Once you make your investment, it could grow tax-free. Your gain is actually free, which is great, although Congress could change the laws anytime. 401k, it's basically deferred. You pay taxes when you take it out as a retirement or distribution. So think about tax advantage accounts. And then lastly, as a recommendation, have a variety of accounts. Particularly if you want to retire early or you want to have that ability, that financial flexibility, because if all your money's in a tax advantage account and you can't touch it without a penalty until you maybe reach age 62 or 65 or 67, without a big penalty, like a 10% or more penalty, and it's all in that one spot, well, that might limit you if you want to retire at 59 or 55 or 45 maybe, whatever your goal is. So you want to have a variety of accounts would be my recommendation, especially around if you think that someday you might want to retire early. Weigh that versus the tax advantage accounts, of course, too, because of that deferral, but it doesn't hurt to have a variety of accounts. That's what I have. I have a variety of accounts, and I'm really glad I did, because now I have flexibility as far as my own what I want to do with my life and what I want to do. So I have some flexibility with that. So that's something to think about too. And last thing under the tax considerations is not to, unless you really high income or something where you really are getting killed on taxes or something, don't make investments solely based on the tax considerations. I mean, you might buy a poor, underperforming fund, but it's, advertised itself as a tax advantage fund, and yeah, the taxes might be lower, but maybe you'd be better off buying that mutual fund that has such great results, and yeah, you pay a lot in taxes, but in the end, you're keeping more because the results are so much better, versus the fund that's not so good and you're not keeping, you made a little bit more as a percentage, but you're really not making overall more as far as a total because it's not as good a fund. As an example from a mutual fund thing. So, when you're investing, consider taxes, but don't let it drive your investment idea solely just based on taxes, unless you're once again getting really socked by taxes. And that's where you might be wanting to, spend a little money into like a tax account or a tax financial planner that can help you from an overall tax type of strategy. But really think about what's the best investment for you. But in the back of your mind, also consider the tax and fee thing considerations, but don't let it dominate totally because you might be missing out on some terrific gains.